What's up guys, Ben here and welcome to Motivation to Invest. Cathie runs ARKK Invest, an investment firm which specialises in disruptive and innovative technology. She's widely regarded as one of the biggest Tesla bulls and predicted that stock to reach $5,000 per share.
ARKK is a global investment firm, and we are focused only on disruptive innovation. That's our sole focus. We believe that investors are missing out on some amazing opportunities out there just because of how the traditional financial world is set up. It's very siloed, specialized in a world where technology is permeating every sector and innovation platforms are converging. DNA sequencing, robotics, energy storage, artificial intelligence, blockchain technology. These are the 5 major innovation platforms today that are evolving at the same time. We have never seen this amount of innovation evolving at the same time in history.
And thank you everyone for joining us. We're happy to have you with us today. So second quarter is quite a bit of history, and we did have a market update earlier this week, as Tom said. We were able to get through the macro and market commentary. Here we're talking more about the economy. As many of you know, we have been expecting a V-shaped recovery. The stock market certainly has moved in a V shape. We're getting a lot of evidence today that the V shape is playing out in the economy as well, starting with China. We've gotten some PMI services data, which is way above where it was before the crisis, industrial production as well. And in the United States, we're also seeing some variables that are reaching above where they were before the crisis, including, interestingly, retail sales. And what that's telling us is that the consumer is still feeling pretty good. The various confidence indices are moving up. The payroll protection plan and additional initial unemployment claims money is playing out. If anything, and I think we're all hearing this from anecdotes, there are people staying away from work because about 60% of the people receiving those checks are making more than they did at their jobs. So that will be ending at the end of this month, and we think will continue to stoke the fire. The consumer saving rate has been remarkable. It moved from 8% in March to 33% in April and 23% in May. 33% is a record-breaking number. We have never seen anything like that. A couple of things were going on there. Of course, there was a lot of fear at the beginning of the pandemic, and so there were these were precautionary balances building. And then, of course, there were few places to spend the money during March, April, and into May. And now we're seeing a lot of pent-up demand because I think a lot more people are comfortable with what's going on. The big surprises have been in housing and autos, 2 of the most cyclical sectors in the U.S. economy. We got the home builders index this morning, and it is pretty much back to its level before the pandemic. Auto sales have also been surprising, and in fact, what we're seeing in the auto sector, we will see more broadly in the industrial sector, and that is that consumers are way ahead of businesses. Businesses are scrambling to catch up with consumers. Inventories have been falling, and businesses have been cautious for the last year to year and a half already because of the China-U.S. trade conflict and the saber rattling, as well as the inverted yield curve that took place last year, after which time, or during which time, many economists, and most I would say, were suggesting that the inverted yield curve was a harbinger of recession within the next year to 18 months. So we saw inventories before the pandemic not keeping up with consumption. We saw a pullback in capital spending, and now we're seeing businesses behind the curve. This is by definition a V-shaped recovery. We've already seen retail inventories for May and they were down 5 to 6% on a month-to-month basis, which is pretty shocking. And then today's retail sales report was another upside surprise. It was closer to 7% than the 5.5% increase expected. So the V-shaped recovery, we believe, is well underway. And you can see that relative to the S&P 500 index and the MSCI World Index, ARK's portfolios did outperform. If we can go to the next slide. We've been beating this drum for a while. If there were ever a perfect storm, this was it. Innovation gaining traction during a tough time. I think every one of our innovation platforms kicked in and became a solution to the problem. And many of our companies are reporting numbers for the second quarter that were higher than expected even before the pandemic. And platforms have probably in just a few months done more than many of the companies involved in them expected during the next year in terms of just adoption or willingness to adopt. And so you can see in a down year to date, our portfolios are up. I think speaking pretty loudly for this idea that innovation really does solve problems. And if 32% sounds like undervaluation, perhaps it is, but it is also a reflection of the kind of growth that we expect from the technologies underlying these 5 platforms.
I'll start off by talking about one of our top contributors for the quarter, Tesla. So Tesla pretty handedly beat first quarter delivery expectations, which propelled the stock. But there were sort of a number of factors for the quarter which could have supported it. There's also excitement about the new potential factory in Texas for the Cybertruck. And I'd say that, you know, the deliveries, I think, gave confidence that Tesla can sort of carry through this period of the Fremont factory shutting down temporarily and sort of, you know, broadly the coronavirus pandemic. So we still see, you know, Tesla is very much a leader in the auto space and think that there could be, you know, more consolidation coming for the rest of the industry. I'll quickly touch on one of the bottom 5 stocks you see here, Nano Dimension, less of a contributor for the quarter. This company is particularly interesting to us because it's very unique. Nano Dimension 3D prints multi-layer printed circuit boards. It's really the only company that can do this successfully today, and it's I'd say the company that's closest to being able to 3D print with electronics, which is very exciting. So this is a very small company. It's a $90 million market cap, but they've made a lot of waves. They have contracts all over the world with the U.S. government and many other international governments as well. For their technology, and they have a new CEO, and they're working through reconfiguring their reseller network, basically in a plan that should improve margins. And right now they have their latest printer is a lights out 24/7 3D printer. So that's sort of something exciting to look out on for the horizon as well. I'll now pass it to my trusted partner analyst, Sam Porras.
Thanks, Tasha. I'll take it back to the contributor side, the top contributors. And one of those was 2U, which is an online education platform. And if you want to talk about a perfect example of gaining traction during a time of crisis, for 5 years, you can go back and look at 2U's quarterly calls, and each time they mention the stigma against online education as a headwind. And then all of a sudden you have every school in the nation go remote. And so analysts picked up on this and started to really hone in on 2U's competitive advantage and offering a more unique experience rather than just Zooming lectures to the students. And then 2U also expanded its partnership with Simmons University to an undergraduate program, which is very exciting as that increases the addressable market for the courses that they are delivering. On the lower end of the contribution side, we had Virgin Galactic Holdings. And Virgin Galactic was very volatile over the quarter. It surged when SpaceX had success with its Crew Dragon launch, just being associated with aerospace and the new excitement there. But then it was brought down as Richard Branson sold some of his shares as he was helping to fund his other airlines as they were struggling. But Virgin Galactic continues to make progress towards its goal of launching a human into space, and it completed a test flight, and it also signed a Space Act agreement with NASA, which is very exciting, and they're going to work to develop a new private orbital astronaut readiness program.
Thanks, George. The other contributor that we want to go over this quarter is Pinduoduo. Pinduoduo was a top contributor this quarter as it continued to execute on its social shopping experience. And starting with some background, social commerce, the space that Pinduoduo operates in and is helping to truly pioneer, makes up roughly 5%, or is about $215 billion in market of the total e-commerce market, which is about $4.5 trillion, and that was in 2019. But we see a lot of growth in this area with new companies like Facebook and Pinterest and a lot of these social media companies now starting to offer e-commerce solutions as well. So we estimate that this space could balloon to roughly 2.8 trillion, or roughly 19% of the expected 14.7 trillion total e-commerce market. And in this quarter, Pinduoduo announced that it now has the fastest user growth rate compared with other e-commerce platforms in China among the ages of 19 and 35. The company was only founded 5 years ago, and it's now the second largest e-commerce company in China with 600 million annual active buyers. And with that, I can hand it back to George.
So we'll start with you, Cathie. A number of questions have been coming in, and I think this is a good opportunity on this call to talk about this, that certainly with the largest weight in Tesla, a bullish position in Tesla, and yet there have been trims and sells of the name that reflected in the trading sheets. Can you talk a little bit why you have to sell Tesla despite your bullish outlook?
Sure. Well, it's called portfolio management. We are managing a portfolio of stocks, and Tesla is absolutely our largest position and highest conviction stock. But watching it go from $350 in March to $1,500, we will take profits. And the reason we do this is, first of all, to manage the position size. If we didn't, Tesla by now could be 25% of the portfolio. That is not sound portfolio management, and it's not what we have told our clients that we do. The second reason is disruptive innovation is controversial, inherently controversial. And so we know once a stock has had a move such as Tesla just has, there could be any number of controversies that will come around and clip it. And we would like the latitude, and it's important psychologically from a portfolio management point of view. If we've taken profits and then the stock drops below 10% again, it's roughly 10% now. If it drops below 10% again, we have the latitude then to buy back. So it's really a portfolio management answer. You know, in my personal portfolio, have I sold any Tesla? No, but I am in the portfolio management business, and what we've promised to our clients is a well-diversified portfolio of innovation. And so this gives us an opportunity to build positions perhaps that are misunderstood and likewise inefficiently priced, maybe even more so today than Tesla is.
One more for you here, Cathie, is how do you view these ETFs in the ARK ETF suite relative to one another from an investor's point of view? in terms of owning multiple, in terms of overlap, in terms of how the weights in ARKK and the tilts have differed over time?
Well, they're all actively managed, and I think the cross-sector nature of each of them gives us some diversification. The 14 underlying technologies, if you look at the overall innovation portfolio, the 14 underlying technologies actually have a lower correlation than the stocks within the S&P 500 do. The genomic revolution is very different from autonomous taxi networks. So the diversification in ARKK is natural because we have 5 innovation platforms, 14 technologies that have a low correlation of returns. As far as the other ones, what we see our advisors doing is if they believe, as we do, we could be wrong, that the genomic revolution is probably the most misunderstood area of the market today because of the convergence among sequencing, artificial intelligence, and CRISPR gene editing. Most firms are not set up to analyze that kind of convergence. Then we see advisors tilting. They may have a core in ARKK and they'll tilt with ARKG. If they're excited about the autonomous revolution, and it's not just autonomous taxis, it's drones and other robots effectively, they might tilt towards ARKQ. And if they believe that the coronavirus has accelerated has accelerated the movement into the digital work and life age, then ARKW. So we see some tilting that way, and so that's how I'd answer that question right now.
And certainly owning the individual themes, there are many more names and they go deeper. A question for Tasha and for Sam, as we look at the clock here. Which will/would have the biggest impact on Tesla? A stock split, battery day announcements, or more competition falling off in the autonomous driving space?
Sure, I'll start this one off and then let Tasha add in. I think when we're looking at the valuation, and you can look at this on GitHub because we've open sourced the model. The biggest source of upside comes from enabling autonomous capability. We do expect exciting announcements from Battery Day, and that will continue them along the cost decline curve for lithium-ion batteries, which will make their cars more competitive at a lower price point. But I'll pass it on to Tasha to discuss the autonomous nature of things.
Thanks, Sam. I'll say, I think Sam put it well. This is, in our bear case for Tesla, we're basically assuming that they are unable to solve for full autonomy. This is still an unsolved problem. But in our bull case, which we assign a 30% probability to them solving for it. So our bull case includes an autonomous taxi network, which we think could provide a huge potential upside. One thing that I'll add on Tesla, some of our latest research is we think that Tesla could launch a ride-hailing service with human drivers. For the bear case of the model that does not include autonomous driving, this basically allows Tesla to have a software as a service like business model with recurring revenue streams without making this huge technological leap and solving for full autonomy. And we're working on that research currently. I'd say for competition in the space, we see Tesla as currently years ahead of competition. I think for a company to catch up with them on a data advantage basis, that would take years, really, just because of the scale that they have with their customer fleet. So it'd have to be, some other breakthrough. So we're constantly looking at that, but that's our current stance on sort of that.
And let me know what you think of the stocks I mentioned in this video. What stock will you be buying in October? Let me know those thoughts in the comments below, and we'll get the entire community involved. And if you enjoyed this video, feel free to give it a big thumbs up. That really helps out with the YouTube algorithm, which allows me to create more great content like this for you guys. In addition, if you want more investing tips and exclusive stock market picks, which I personally am investing into, then you should definitely subscribe to this channel and turn that notification bell on. With that being said, I wish you guys well, and I'll see you guys in the next video. Invest safe.